I think the thing to look at is the silver price in China. It's still well above here. Demand for silver is basically off the charts. And you've got two things now working for higher prices. The first is industrial demand. Bear in mind that India's industrial demand is increasing very, very rapidly. The second thing is that you have in Asia, if you like, a greater affinity with silver as metallic money than we do in the West. In the West, we see it as small change, silver coins, which are always fairly insignificant in terms of their value. But in Asia, it's a completely different story. China was on silver standard until 1935. And in the Middle East, when I first went to the Middle East, which was in the 1970s, Maria Theresa dollars were still circulating and being used as money, certainly in the Bedouin tribes and also, a bit more widely. So, they know that silver is money. We slightly dismiss it. And consequently, you've still got queues around the block for, silver bars, silver coin, whatever, throughout Asia. Now, we're talking about a very large proportion of the global population, if you like, going for it. So silver, if you look at the price in China, in Shanghai, it closed last night at something like 111, while here we were around about 80 or a bit less than 80. So you can see that there's a significant premium there. Our paper price hasn't caught up with the physical price. And I think that's the key thing to understand. So I think it's being drained out of Western markets. It will go back into China so long as there is the arbitrage. There are costs involved in arbitrage, obviously. But I can't see how the Chinese banks with branches in London will just sit on their hands and say, well, there's no silver in London. We won't bother. No, there is an arbitrage opportunity. And I think they'll probably take it on Globex anyway, the international version of the COMEX. So I think that's the basis of it. I think the other thing to bear in mind is that if you look at the value of base metals measured in gold, because gold ran up quite strongly, it may be a bit ahead of the game in terms of the falling purchasing power of paper currencies, but nonetheless, it means that it has left behind base metals and other commodities, which basically is what the gold's value represents. And so I can see in 2026, I can see a substantial uplift in commodity prices measured in gold, and even more of an uplift in depreciating fiat currency values. So, that's going to give us, I think, a huge, great problem with inflation later on this year.
Yeah.
You can see that the producer price index, I think you'll find that's really going to rise. We had a 3% rise overnight, but in America, but that's just the, hardly the start of it. I think there are going to be real problems on that front. And of course, as you get the falling purchasing power of the dollar, gold, silver, platinum group metals, copper will continue to rise and rise a lot more strongly than you think is likely.
Silver is already trading near $110 in China, while the West is still stuck below $80. That gap isn't speculation, it's physical demand overwhelming paper pricing. According to Alasdair, industrial demand in Asia, especially India, is accelerating fast, while silver is still treated as small change in the West. Asia sees silver as money, not a trade, and that cultural reality is pulling metal out of Western vaults through arbitrage. As paper prices lag real demand, silver is being drained eastward, and when paper finally catches up to physical, the repricing won't be gradual. That's why Oliver warns this isn't just a silver story, but a setup for broader commodity inflation as fiat purchasing power continues to erode.
I think we should bear in mind that the authorities are actually quite good at hiding these things. If someone gets into trouble, they will be bailed out and we won't know about it. I mean, there were all sorts of stories on this shakeout about how, dealers were getting into trouble, therefore they manipulated the price down and all the rest of it. I mean, I don't think that's true. I think what we saw was something which was an opportunity by the swaps, by market makers, by bullion banks, basically to hit the expiry of the February contract at a time when China had packed up and gone home for the weekend. I mean, that's the time when they can just push the price anywhere they want. There's no speculative or very little speculative interest. I mean, this is an amazing thing. If you look at the commitment of traders figures, which separates out the managed money, in other words, hedge funds, and speculators in the other reported category, I mean, they weren't long. They really weren't long. And indeed, hedge funds have been selling gold down, certainly from around about the middle of December. It was only really in the last sort of week or so of, into mid-late January that they were actually increasing their position. So there were a few people to shake out, but not all that many. Without any speculators in there, you're not going to get the sort of volumes, if you like, which, where you got people saying, okay, it's fallen so far, time to buy some sort of thing. They're just not interested. I think they're all scared stiff of what's going on or not understanding it. I mean, you would think that you would get momentum chasers in there, but they're hardly there. It's an extraordinary situation. The amount of speculative activity to shake out here has been virtually none, which really means, ironically, that the swaps, the market makers, I mean, they could just mark things down as much as they want without really being challenged. And I think that's roughly what happened.
Yeah, China is factor, always has been a factor, but reports of China buying large quantities of silver and gold during recent dips have circulated. But the verification remains challenging. How do we know how much China bought precious metals? And what role do you see really from the Eastern demand going forward?
Yeah. I suppose in the fullness of time, we might see, some, if you like, sort of trade statistics. But I don't think that's really going to give us much of an indication. I mean, I don't think we need to try and examine this, to overthink it, to examine it too deeply. Just look at the premium in Shanghai compared with prices in the West. I think that's all you need to look at. And as long as the premiums are there, you can bet your bottom dollar that it's going to drag us up. And that's actually what's happening today. I mean, we've had a pretty good rally today. I mean, as we talk, I can just get my chart up. I mean, we're looking, silver is up 12%.
Yeah.
Gold
is nearing 5K again, right?
Yeah. I mean, gold is interesting because there isn't very much difference between the price on the Shanghai Gold Exchange and the spot price in London. There's not a lot of difference. And I noticed also that JP Morgan are now forecasting a price at the end of this year of over $6,000, which tells me that they've got an even to long book. So, I think that's the way of it. I think that they're probably more frightened of getting short in silver than they are gold. I mean, there is a bit of a flow in gold, and you can keep your position level. Perhaps when gold ran above $5,000 up to $5,500, there may have been some who found that they were net short. You're looking at positions across COMEX and London. And on that basis, they would have joined in, hitting the price, banging the price as much as possible to try and get some stock back. But there again, if you look at the contraction in open interest, I mean, it wasn't as much as you would think on a hit in the price of that magnitude. So, I mean, we know what's happening to gold. The managed money category are just not interested broadly. I suspect they're all chasing, tech stocks and things like that, which is yesterday's story. And of course, the other thing is Bitcoin. There's some big losses beginning to emerge in Bitcoin. And I think if that falls, below the current levels by much, that is going to destabilize quite a lot of investors. Might even chase some money into the precious metals. I don't know, but that's something which will be interesting to watch.
Yeah, I'm seeing on social media, even some Bitcoin bears are saying that Bitcoin is nearing a good price and good entry price. Do you own Bitcoin, Alasdair?
No.
Not
And
at all.
I can tell you that reasoned economic analysis and understanding the law of money and credit, they are worthless.
Agreed.
Forget it.
Yeah.
They will go to zero.
Yeah. You had a pretty good interview recently with my very good friend Jesse Day from Commodity Culture, and you discussed the potential end of the fiat currency regime. What specific economic triggers, such as resumed aggressive money printing by central banks, could accelerate this transition towards sound money?
Well, debt is the underlying condition which always ends a fiat currency. And the way this one is going to play out, I mean, we can see it now. What will happen is that the U.S. Treasury will have difficulty funding its debt because it's rolling over, I think, almost 1/3 of the total outstanding debt. Plus, of course, around about this year, we're looking at a further $2.5 trillion of deficit to finance at a time when foreign interest in U.S. treasuries is declining. And that decline, I think, accelerated on the back of what happened with Venezuela and the saber rattling over Greenland. I think you'll find that foreigners will be less and less interested in buying U.S. Treasury debt. So what that will do is it'll drive up bond yields along the yield curve. We can then see that will pop the equity bubble. And you've got a situation where, last time I looked at it, there was $44 trillion of foreign investment in onshore US dollars. We're not talking about Eurodollar markets, which are offshore. That's another 13 trillion or so. I mean, 44 trillion is a huge, huge number. And of that, something like 22, so, approximately half, maybe a bit more than half, is invested in equities. When you get a rise in bond yields and that upsets equity, the valuation for the equity market and generates a bear market, I think foreign investment in the US treasuries is going to run for the exit. That will collapse virtually everything. So what does the Fed do? Well, the answer is the Fed and the US Treasury have a mandate. It's a very clear mandate to support the banking system, to support businesses in trouble because they're over-leveraged in debt, and also, crucially, to support the stock market, because there is this belief that so long as Americans are making money in the stock market, they're all happy and everything's fine and they're all confident. I mean, that goes back to Greenspan. That was more or less what he said. So you can see what's going to trip the whole thing up. Now, the response basically to deal with all those issues will be a massive expansion of QE and interest rate suppression below where it would be. So what does that do to the dollar's value? It collapses it. So you can see how important this debt thing is just going to trigger the end of the fiat currency regime, which is led by the dollar, because once the dollar goes, the rest will go with it.
Sure. Final question, final topic, digital currency. How will the digital currency world look going forward in the next 2, 3, 4, 5 years for the average man on the street?
Well, I think this digital currency thing is overhyped. When you get the end of the fiat currency system, digital currencies, if they exist, will go with it. I mean, there is actually no technical difference between a digital currency and bank credit. The only difference is that digital currencies are intended to be issued by central banks directly into the economy, bypassing the commercial banking network. I don't think it's going to happen in America, for a start, because they're not interested in it, one. And secondly, the commercial banks basically finance every politician. And I don't see the political class supporting any legislation bringing in CBDCs. That's not going to happen. Forget it. All it is, it's extra credit, not backed by anything. It's the credit's value which is collapsing. And it doesn't matter whether it's in the form of CBDC or bank credit or whatever. It really doesn't matter. It's all going down the Swanee. So this is not going to rescue the situation. It's not an alternative. Forget it.
Okay, if not digital currency, any form of gold standard again?
Well, that's not the plan. It really is not. I mean, I think China has plans to put the yuan for trade settlement purposes onto a gold standard. But, the technical way in which she will do that, we'll wait and see. But, that is a very, very different thing. If it's actually on a gold standard, then a currency, whether you call it CBDC or whether it's bank credit or whatever, for a particular purpose, that will secure its value, which is fine. I mean, that's like sort of, if you like, a new spin on Bretton Woods. And it would work in China's case, I'm sure, because they've got the underlying economy which can make it work, which wasn't the problem, wasn't the case with America. I mean, America was trying to rule the world and all the rest of it, and spending way beyond its means all the time. That's not the situation in China. China can actually keep her spending under control. She doesn't have all the welfare commitments and all the rest of it, which is so destructive of Western economies. I think is also possible, and this is something which something I've been airing over the last few weeks. It's also possible, I think, that China might, because she's got very strict exchange control regulations, separating off international use of the yuan for trade settlement purposes from the domestic use of the yuan. She could easily, at some stage, put the domestic yuan onto a silver standard. Yeah. And then she would have to regulate the price between gold and silver. But she could do that. I think once silver rises to the point where you're looking at a gold-silver ratio of less than 20 and probably in the order of about 15 or 12, then I think she could do it. I mean...
Do you see that happening? The silver ratio of 15 to 1?
It's quite possible because, as I said earlier, the last metallic standard that China had was actually a silver standard. And I think it's in the psyche of the Chinese that is real money. And I think also in India, it's the same situation there. The silver is accepted as real money. And I think India could also do the same thing if she was minded to do so. And again, India has got the exchange controls, so she could do that. What that means, and this is an interesting point, is that we could see something like 2.5 trillion of the world's population, which is 30-odd%, 35% of the world's population on a silver standard. Now that's something to consider.
Yeah.
I'm not saying it'll definitely happen. I mean, I'm just sort of throwing out an idea. Yeah.
Totally. Alasdair, how can people reach out to you? I know you have a very successful Substack. Tell us more.
Yeah. My Substack, which is macleodfinance.com, it's cheap, $100 a year. And I think that it's worked very, very well for the people who have actually subscribed for it, for the paid version. Really, what I'm trying to do is I'm trying to educate people about the problems and the pitfalls which they're going to find protecting their savings, their wealth, if you like. And it means understanding the difference between money and credit, and understanding what drives markets generally, and understanding what the economic underlying situation is, not what the governments are telling you, but, a more sensible, if you like, and unbiased analysis of what it is. And so it's working very, very well, I'm glad to say, and quite a lot of people are joining in. And I would encourage everyone to come and subscribe, because I think it'll help you protect your wealth, whether you've got lots or whether you've got very little.
So, when you step back and connect the dots, the signal becomes clear. Silver isn't rising because of speculation or short-term volatility. It's being pulled by real demand. Asia is paying a physical premium the West hasn't priced in, industrial demand is accelerating, and metal is quietly flowing out of Western markets through arbitrage. At the same time, falling fiat purchasing power, rising producer prices, and structural stress in debt and equity markets are forcing capital back toward hard assets. What looks chaotic on the surface is actually a repricing process, one that authorities are skilled at masking until it's too late to ignore. Now that you understand why silver's physical price is leading the paper market, there's one more piece you need to see. In the next video, we break down where this pressure shows up next and why the financial system may not be ready for it. That's the video you need to watch next.